It's time to forget everything you thought you knew about gold investing. Both the risks and opportunities have changed while no one was looking, and most investors simply are not prepared for the new reality. In this video, we'll cover three things: what has and hasn't changed about the drivers of the gold price, and how that's creating both new risks and new opportunities, my outlook on the gold price, and a gold related investment opportunity that you've probably never thought of. Let's start with what's changed. Gold is still a safe haven asset, right? Well, sort of. In the tech downturn of February through April of 2025, it certainly behaved that way. This is the NASDAQ in blue and the price of gold in, well, gold. Long term, I would describe gold as simply uncorrelated with most other major asset classes like stocks and bonds. It hasn't consistently done well or poorly when they've been doing well or poorly. Its price was just not that related to the prices of stocks and bonds. So, in an equity downturn, it wouldn't necessarily go up like it did here, but it would generally do better than equities because whatever was impacting stocks probably was not impacting the price of gold. I think in the long run, it will still be that way, but recently, some things have started to change. Over the last 2.5 years, and since the April 2025 tariff reversal, some of the biggest gains investors have made have been in gold and tech. Most of this timing has been coincidence, but it's led to an important change in the market that few people have noticed. All of a sudden, gold and tech have started to become closely correlated. Gold has been selling off when tech has sold off, and gold has been rallying when tech has been rallying. Why do you think gold is a safe haven asset or just an uncorrelated asset? Either way, that's not supposed to happen. So, has gold turned into a risk asset like stocks or Bitcoin? Yes, temporarily, I think it has, depending on the cause of the next downturn. To understand why, we have to understand a little bit about investor psychology. It's a phenomenon called loss aversion. We explained it deeper in this video, which was part of our Psychology of Money series that was absolute gold, in my opinion, pun definitely intended. This was some of our most valuable and underappreciated content we've ever done. But in short, loss aversion is the mental phenomenon where people hate losing more than they like winning, and it causes them to make some strange decisions, both with their investments and elsewhere in life. It comes into play here because one of its impacts is that it causes people to sell whatever they have that's up, because they'd rather lock in gains than take a loss. What do most investors have that's up a lot? Tech and gold. So, in the next equity downturn, tech and gold are likely to sell off the most, even if that doesn't really make any sense, which it probably won't. That's why tech sold off way more than other stocks in April's tariff bonanza. What did that have to do with tech stocks? Not much. Half the companies basically don't even import anything. But people were just selling what they had that was up. Now, gold did quite well in the environment, but then, more recently, it didn't. So, what gives? Well, that's why I said it might turn into a risk asset depending on the cause of the next downturn. In most downturns, I wouldn't be surprised to see gold sell off. Maybe not as much as the riskiest assets like small caps or whatever is causing the downturn, like tech if it's an AI bubble bursting, but it will probably go down in most scenarios. The exception is if the downturn is caused by, or at least coincides with, a loss of faith in the dollar. That's what happened in April 2025, and that's why gold rallied at that time, and really for most of 2025. For a variety of reasons, which can all basically be summed up as erratic and unpredictable policies, investors began to doubt the safe haven status of things like treasury bonds and look for alternative safe havens, like gold. When investors lose faith in the dollar, gold is one of, if not the main alternative. And this year has been one of the worst years in decades for the dollar. That brings us to the next key way that gold investing has changed. It may not be a safe haven in the next downturn, but is it at least still an inflation hedge? Nope, not really. This is a 1-year change in the gold price in yellow compared to the CPI in purple. Does this look like it has a close relationship to you? If that wasn't clear enough, take a look at the big spike in gold prices in 2019. Inflation was flat. Then it spiked again in 2020, when inflation was falling. And in 2021, as inflation was skyrocketing, gold collapsed. Most recently, gold has risen a lot again as inflation has come back down. That doesn't look like much of an inflation edge to me. Sure, maybe over decades it could be, because both inflation and almost all asset prices are likely to go up over time, including gold. But I'd argue that equity prices are actually a much better long term inflation hedge. So, why the confusion? And then, when would gold be an inflation hedge? Well, the confusion stems from the fact that inflation can be caused by more than one thing. Some impact the price of gold, and others don't. In 2022, inflation was driven by three things: rising US government spending, rising goods prices from post COVID supply chain disruptions, and rising energy prices from the war in Ukraine. Rising goods prices due to temporary shortages, whether from supply chain disruptions or simply supply disruptions, like the supply of oil and gas from Russia, for example, cause rising inflation but have nothing to do with gold. Excess fiscal, aka government spending, can impact gold prices if it weakens the dollar, because gold is seen as a dollar alternative. But in 2022, that didn't really happen because the market mostly believed that COVID and post COVID fiscal spending, even if it had gone too far, would ultimately come back down. Put simply, they saw it as a one off temporary phenomenon due to a once in 100 years crisis. Nobody really feared the downfall of the dollar. Well, maybe not nobody, but those who did were unknowingly falling victim to a Russian propaganda campaign that tried to stoke dollar fears by manipulating crypto and gold enthusiasts to spread rumors in American media. But I digress. We've spent more than enough time in that rabbit hole and have no desire to go back. The third way that gold has changed is that it's not just a risk or inflation hedge anymore. In my opinion, there's also an interesting opportunity in gold that didn't exist before. But even bigger than the opportunity in gold is the opportunity to drastically change your life by becoming a better investor. And helping you do that is the main reason that Kyle and I started this channel. So if you're in a 70% of our viewers that's not yet subscribed, and you want to learn how to invest from actual investment professionals with no gimmicks, no fear mongering, no secret agendas, no BS, all you have to do is hit that subscribe button. It costs you nothing, and it really could be one of the best decisions you ever make. Just ask Alfresco, who wrote to thank us for a whole list of videos on many different subjects, and then asked us to cover gold and precious metals. Alfresco, without that comment, we wouldn't have made this video, so I hope it's as helpful as the others. And to anyone else who just subscribed, thank you so much, and we will do everything in our power to earn one of these posts from you one day. Let's start with the new opportunity that I see in gold. Sure, it can still function as a hedge against rising dollar fears, and in the long run, I think it can still serve its purpose as an asset that's uncorrelated with stocks and bonds in your portfolio. But something else has changed recently that's creating a new opportunity in gold. Let's go back to our 10-year gold versus tech chart. Why do you think both are up so much over the last 3 years? That's a trick question. Those increases have basically nothing to do with each other. Tech is up because of AI, but you probably already knew that. Gold is up because when Russia invaded Ukraine in 2022, the West cut Russia off from the global financial system, and other potential future adversaries, namely China, decided that they didn't want to rely on it so much anymore in case that would have happened to them at some point. Now, getting off the Western financial system is definitely easier said than done, but one thing that China has been doing is massively increasing the percentage of their reserves that they hold in gold, while decreasing the amount that they hold in US Treasuries. A country's reserves are sort of like a country's savings account. Yet, despite these massive purchases over the last few years, according to the World Gold Council, China's gold as a percentage of their reserves is still among the lowest in the world. I think it may be a little higher than what they're letting on, but they still have a long way to go just to get to where most other developed countries are. And to get there, they've been buying around 30% of the global supply every year for the last couple of years. That is the main reason that the gold price has been going up so much from what I can tell. And I don't know where they plan to get to, but it would take them years more just to get to where most other similarly developed countries are. And many of those are not realistic potential adversaries of the US that are trying to reduce their reliance on dollar-based assets. So this growth story probably has legs, meaning it can go on a while longer. Now, to take advantage of this, you can invest in any number of gold-linked ETFs, and there are a lot of them. This isn't even a complete list. I actually own some UGL, which is a 2x leveraged gold ETF. But I promised you a gold related investment opportunity that you've never thought of, so let's focus on that. Recently, I took a position in GDXJ, the Van Eck Junior Gold Miners ETF. This basically invests in small gold miners, which, let's be honest, often have some air on them, meaning they're not always managed the best, they operate in risky areas, they are always the greatest companies. But what that means is that often their share prices don't react as quickly as gold prices when gold starts to rally. And then later in the rally, when the market realizes that it's for real and it has legs, their share prices catch up. So they don't do as well as gold early in the rally, and then they do better than gold later in the rally. If we just go back 3 years, we can see this in action in this cycle too, with GLD, one of our many generic gold ETFs, in gold, and GDXJ, the Van Eck Junior Gold Miners ETF in blue. Gold was ahead, and it was ahead, and it was ahead, until the last few months when GDXG pulled ahead and surpassed it. Obviously, we're not at the beginning anymore, it's not as cheap as it was before, but if you think this gold rally can continue over the coming years like I do, or even if you just think gold prices can stay relatively high like they are now, I think GDXJ has a good chance to do better than gold from here. As with pretty much all investments, with higher potential reward also comes higher risk. So proceed with caution if you decide to buy, but if you're bullish on gold, this is a compelling way to invest in it, in my opinion. When I think about the trajectory for gold over the next couple of years, yes, it could sell off in a downturn that has nothing to do with gold. And of course, after such a big rally, it's natural to have some pullback, so don't be surprised by that. But having such a huge buyer in the market, meaning the China Central Bank, that isn't really price sensitive, gives me confidence to buy the dips. Then, when I think about the other drivers of gold, are fiscal deficits in Western countries going away anytime soon? I doubt it. Could there be more threats to Fed independence? Yes, there could. Gold tends to move in long cycles, and even though it's rallied the last few years, I'm still bullish on it over the next few years. Maybe not to the same level of rally that we've seen over the last couple of years, but I definitely think there's more upside potential. And if it does keep going up, I think that junior gold miners are an interesting, higher octane way to invest, particularly at this part of the cycle after we've seen the early part of the gold rally. If you found this video helpful, let us know by hitting that like button. And if you want to get access to all of my investment ideas, most of which we do not do videos on, along with my personal holdings, the model portfolios, and the bi-weekly calls where we answer your questions directly, consider becoming an Academy member. The link is in the description. Thank you so much for watching, and I look forward to seeing you in the next level.